Forex news trading involves making trading decisions based on news releases and economic events that impact the currency markets. It's about capitalizing on the volatility and price fluctuations that occur when important economic data is released. Imagine a sudden surge in the value of the US dollar after a surprisingly positive jobs report. That's the kind of opportunity Forex news traders look for. Unlike traditional trading strategies that rely on technical analysis and chart patterns, news trading focuses on the fundamental factors driving currency values. By understanding how economic indicators and geopolitical events influence currency pairs, traders can anticipate market movements and make well-informed trading decisions. New traders are often drawn to Forex news trading because it offers the potential for quick profits. News releases can trigger significant price swings in short periods, allowing traders to capitalize on these short-term opportunities. However, it's crucial to remember that news trading also carries its own set of risks, and it's essential to approach it with a well-defined strategy and risk management plan. In the next section, we'll explore the profound impact economic news has on Forex markets, providing a deeper understanding of how news events translate into trading opportunities. Economic news acts as a catalyst for price movements in the Forex market. Positive economic data from a country often strengthens its currency. For instance, a strong U.S. jobs report might boost the U.S. dollar, as investors see it as a sign of a healthy economy. Conversely, negative economic news typically weakens a currency. If a country reports disappointing retail sales, its currency might depreciate as investors become wary. This constant flow of economic data creates volatility, offering traders opportunities to profit from price swings. The key lies in understanding how different economic indicators influence currency valuations. For example, interest rate decisions made by central banks are major market movers. A surprise interest rate hike can send a currency soaring, while a rate cut might trigger a decline. By closely monitoring these announcements and anticipating their potential impact, traders can position themselves to benefit from the resulting market reactions. In the next section, we'll delve into specific strategies that traders can employ to leverage news releases for profitable trading outcomes. One effective news trading strategy is to identify economic indicators with a history of causing significant market reactions. These high-impact indicators, like interest rate decisions or employment figures, have the potential to trigger substantial price swings. By focusing on these key data releases, traders can narrow their focus and increase their chances of catching profitable trades. Another strategy is to trade the news during off hours. While major news releases can cause sharp price movements, these moves often stabilize after the initial volatility subsides. By waiting for the market to digest the news and for trading volume to decrease, traders can potentially enter trades at more favorable prices with reduced risk. However, successful news trading isn't just about reacting to headlines. It requires a deep understanding of the underlying economic landscape. Traders need to analyze past data, consider market sentiment, and gauge the potential impact of upcoming news releases. By developing a holistic view of the market, traders can make more informed decisions and avoid being swayed by short-term market noise. In the next section, we'll explore how to interpret key economic indicators, providing the tools to effectively analyze economic data and anticipate market movements. Economic indicators are statistical data points that provide insights into the health and performance of an economy. These indicators, released regularly by government agencies and financial institutions, cover a wide range of economic aspects, from inflation and employment to manufacturing output and consumer confidence. One of the most closely watched economic indicators is the gross domestic product, which measures the total value of goods and services produced within a country. A growing gross domestic product typically indicates a healthy economy, potentially leading to a strengthening currency. Conversely, a shrinking gross domestic product might signal an economic slowdown, potentially weakening the currency. Another crucial indicator is the Consumer Price Index, which tracks changes in the price of a basket of goods and services, reflecting inflation levels. High inflation erodes purchasing power and can lead to currency depreciation. Conversely, low and stable inflation is generally seen as positive for a currency. By understanding how to interpret these and other key economic indicators, traders can gauge the overall health of an economy and anticipate potential currency movements. This knowledge forms the foundation for making informed trading decisions based on economic fundamentals. In the next section, we'll delve into risk management techniques specifically tailored for Forex news trading, emphasizing the importance of protecting capital in this volatile trading environment.